Hello and welcome back to The Note. Today we're going to be talking about responsible investing, these days often rebranded ESG, environmental, social and governance investing. It's obviously gaining very greatly in popularity. Many people are talking about it. Has it really changed? What does ESG investing really mean? Today I'm going to be talking to the CEO of one of the longest established groups in this sector. He's the CEO of Calvert Investments John Streur. Thank you very much for joining me today. Now, let's start by asking, traditionally ESG investing is about negative screens, about excluding particular sinful stocks. Have we moved on from that? Are we now ready to grade or rank companies positively?
Right, John, I think absolutely. We've taken a couple of steps forward. First, negative screening is really no longer used by the expert practitioners in this space. Secondly, as you indicate, in addition to using research and metrics to avoid the laggards, we can use those same research and metrics to identify the management teams globally who are most capable of dealing with these issues, their impacts, and the risks.
Now, how do you measure this? And how can you measure whether it actually delivers results?
Well, that's a great question. So the first piece of your question is, how do we measure it? We use a set of data that we take in from the financial services industry, as well as information that we get directly from companies, voluntary disclosures around issues as diverse as their board governance systems to their goals around energy use and reduction of carbon emissions.
Now, how much of this is self-reported? I mean, the Volkswagen scandal obviously suggests there can be limits to self-reported data.
Make a great point. Most of it is self-reported. In the U.S., Dodd-Frank made some progress in terms of asking and requiring companies for certain risk disclosures, but exactly the point, most of what we have today is voluntary reporting from companies.
But this now does allow you to produce an actual ranking or a score across sectors, as I understand it.
Right. In addition to the voluntarily reported information we get, we work with NGOs, governments, and securities exchanges to get other forms of information about these behaviors. So we have a wide variety of information that we bring in to create our scores. We use metrics to rate and rank companies within narrow peer groups. That lets us identify the company managements that aren't paying attention to these risks and differentiate those from those who are just barely acceptable, and further to identify the global leaders.
Now, one of the big complaints about negative screening was that it didn't really perform for you. People who had less scruples could buy sinful stocks cheaper and do better in the long run. What evidence do you have that this actually makes people money?
Well, there's empirical evidence today, and we've published some research on this, that indicates that there's a correlation between the stock price performance as well as the credit spread on the debt side of the companies that demonstrate expertise in this area relative to those who aren't really paying attention or who aren't doing this well.
So all other things equal, their stock will sell for a higher multiple of book, and their credit will have a lower spread.
All other things being equal, that's what the evidence shows.
And presumably there aren't enough people buying solely on the basis of your particular ESG ranking at this point. Why do you think that correlation holds?
Well, you say there aren't enough people buying solely on the ranking. There's a very small group of investors worldwide who are really focused on this and who have developed the expertise to understand the data. So at some point I'm sure that this will get arbitraged away. But at this point, it's a fairly small group of people focused on the information.
So you're hoping for the time being that this is an anomaly that people can actually make some money out of?
Well, actually at Calvert, we're hoping that all management teams develop this expertise and all investors join in, because we really want to see our global capitalist system solve our most pressing social and environmental needs.
Okay, one final question. If you want capitalism to work more efficiently, maybe you want to do this through an index fund, which is cheaper. Have you worked out a way to turn this into passive index investing?
We have. Today there are enough companies worldwide doing good work that we can create an inventory of securities necessary to build broad-based indexes. And Calvert is creating indexes that cover the global capital markets. U.S. large cap, non-U.S. large cap, small cap, emerging markets, the full gamut. And we're making those available to investors through mutual funds.
Okay, John, thank you very much indeed. ESG investing, it does appear to me, is coming of age. You do see far more interest in this, particularly as there are very many more voices trying to make capitalism more inclusive. Plainly, however, like any other form of investment, it will have to make sure that it keeps a lid on those fees.